Stimulus is coming, most likely, and we already had confirmation by the Federal Reserve yesterday that they will be injecting around $7 trillion over the course of, it might be less, might be more, but at least they'll keep up the quantitative easing rate that they're currently doing for the foreseeable future, which is 3 to 5 years. That's a lot of money. So what will be the consequences of the Federal Reserve having very accommodative monetary policies and fiscal stimulus? Well, let's find out. One of the worries of many conservatives, especially fiscal conservatives, is that we're going to run out of money. And that is just not true because you can always print money. I'm sure they know that, but they're really worried about that. We'll destroy the dollar and we'll create hyperinflation, which, for some reason, we're not seeing inflation. And the Federal Reserve is correct. And I've said this before on my channel. There's a lot of deflationary forces that have nothing to do with supply and demand. For example, technology shifts like inflation. Technology essentially is deflationary. Every time we have a technological advancement, it reduces costs. Every time we have a gains in productivity, with machines, automation, all of these things, they are deflationary forces. And this is something that didn't exist in the 70s. Well, there was to a lesser extent, you didn't have AI or robotics that you could program and arms that would assemble cars for you. You needed labor. Machines increased labor, but now we have almost machines just replacing people completely. So yeah, a machine doesn't require payment or salary. It's a purely deflationary force. It's like almost 100% deflationary. It just requires capital investment. So what does that mean? It means that they can almost print dollars with impunity. This is the thing about what the Federal Reserve is seeing. They see that they can print dollars almost with impunity, and especially since the dollar is a world reserve currency, they really can almost do that with very little consequences because everything's denominated in dollars. You cannot exchange money basically if you don't go through the dollar, because how it works is there very few countries accept other countries' currencies, but everybody accepts the dollar. So if you want to exchange one currency to another currency, actually the mechanism is first they exchange their currency to the dollar, and then the dollar is exchanged against the local currency. That's how the exchange works, right? It's the dollar in the middle. Sometimes the euro, sometimes the yuan, depending on which region. There are some currencies that are geographically, they are accepted in their local regions. But the dollar is universally accepted. So the Federal Reserve can pretty much print as much money, and actually there is no war chest that's going to be emptied. You don't have to really depend on taxes to fill up the war chest. And we're seeing that, they're doing stimulus checks and they're like, wow, helicopter dropping, it's working. No way. How? Of course it's working. You're giving people money, they're going to spend it. It's going to increase the amount of what you measure in your GDP. But anyways, so basically we're not going to see inflation, and we're not going to see interest rate increases in the short term. And what's going to happen? Because we saw when the Federal Reserve made this announcement, gold basically, if you look at how it's going up, it shot up, right? If we draw a line and we think that this is sort of the long-term average of gold, moving up, we make a projection trend. This is a very simplistic thing. We think that, okay, it should be somewhere around here, the long-term target of gold. We're in an upward month-to-month trajectory. There are times when it's low, there are times when it's higher. Potentially we can see further highs, right? And we moved upwards recently, especially if I go into the daily view. Where's the 1 day? We jump from basically a low of the 1700s, 1770, and then we went upwards towards the 1800s and almost 1900s right now. The question begs Can we see higher prices for gold? And what is causing this higher price? If you talk to somebody who just reads charts, they're going to say, oh, we've got a bullish momentum. Yeah, but bullish momentums are caused by news. And the news is the Fed is going to print more money and for 3 years. That's the news, not the fiscal stimulus yet. Because I think the fiscal stimulus part, because there's so many times it failed, people are a little bit risk adverse against it. They're betting, like there's people betting against it, there's people betting for it, and there's people betting for more lockdowns before the vaccine. You know, there's all sorts of bets. It's kind of like a crazy horse race. But one thing for sure is the Federal Reserve is going to continue on monetary policy, and with the accommodative monetary policy, the fair, like according to some of the machine algorithms I built, they value gold at around $2,000. Not so much that people want to trade or buy gold, but because the dollar is going to devalue quite a lot with quantitative easing. What happens next? Well, one of the effects of quantitative easing and why I think, you know, it's kind of dangerous and why I personally am staying out of the stock market. I think within the next 5 years, we're going to see stock market booms, but we could also see some stock market, I would say, dangers. Like right now, when I go on to YouTube and I look at other people talking about gold and the price of gold, they're really expecting gold to be a hedge directly against consumer inflation and a hedge against the fact that the stock market might crash. You know, they're like, yeah, there's going to be a massive crash. There's stock market crash warnings. Actually, I think because of the confirmed lower interest rates, we're not going to see a stock market crash. We're going to see a stock market hyperbubble. And what do I mean by a stock market hyperbubble? You have to understand, like I explained in a previous video, you can watch that video. It's called like how do interest rate affect bonds? And the relationship is quite simple. You know, if you want to decrease interest rates, you increase the price of bonds you're buying, especially if you're a central bank. And basically you buy the bonds at a higher price and you force the interest rate down. Because bonds have coupons and coupons have fixed yields, and they have a yield at maturity, which is the total number of coupons added together. And that divided by the price gives you the return rate over that time period. And, you know, it's kind of like when you look at it, you're thinking, okay, it's a simple relationship. You know, it's a direct, when you increase the price, you decrease the interest rate. But what about companies? How does interest rates affect companies? And why do I think there's going to be a hyper bubble? Well, there's something I've noticed over the past few years. It's that companies stop paying dividends, right? They don't focus on paying dividends to their investors. It's not the main thing they do. The main thing most companies are doing nowadays is they are doing share buybacks. And we're also in an environment where there's really low interest rate. Bonds are pretty terrible to hold. Like if you look at some of the articles, I know Ray Dalio, he's a big proponent of ETF funds, and he's really like anti-bond, and he believes that people should not hold cash. And he's right. Like bonds and cash, if you look at how the dynamics work in the Federal Reserve is doing, they're like literally worthless as if you want yield or if you want to preserve the purchasing power of either. If you buy bonds at the current price, you know, you're kind of like almost losing 10% of your cash in terms of due to inflation. So it's not great. If you're just holding cash, you'll even lose even more because asset prices are inflating. So you do need to put it somewhere. And one of the places that people are like going to put it, they're going to put it into stocks. They're going to like all in on stocks. This whole area, people just like dump everything into stocks, especially into ETFs. This is kind of dangerous. And the reason why it is dangerous is because when you have low interest rates and you understand a little bit of the dynamics, the interests within a company, is that most companies will use the low interest rate to take on more debt. And when they take on more debt, what they're not going to do is they're not going to buy machines or whatever. They're going to rework their financials to ensure that they increase their stock price through buyback, programs and other programs that benefit the investors in the company. You're like, that's great. I'm going to be an investor in a company. The problem is, it's a little bit not how you should be using debt. In theory, how a company should be using debt is to increase their earnings. If companies are using debt to increase their earnings in a significant manner, something's wrong. Something's really wrong. I'll show you just an example of what I'm talking about because it'll be clear if I show you. So let's say I'm a company, right? And the interest rate is fixed. I'm in a world where there's fixed interest rates. And let's say earnings before I have to pay my pay taxes and interest rates and depreciation, whatever, which doesn't really reduce cash flow, but eventually you have to pay that up. Let's say I'm a very simple company. I earn $30. I only have interest payments. So we're only interested in the debt part. We're only going to explore this part because the other parts do come into play. But right now, the major impact of interest rates decreasing is the debt part. So we're going to look only at the consequences of debt and isolate that. My interest payment on $30 of debt at 7% interest rate, let's say this is like the 1980s, is around $2. So I have $28 left to run my company. It costs like $20. So my free cash is $8. And I decide to do share buybacks to increase the share price. And I decide to try and increase it by 8%. So I buy like, here's a very simple thing. I use all my money to buy shares and I increase it by 8%. My initial share value was $100. This is not exactly how the market dynamic will work, but it's approximation. Just bear with me. It's an approximation. You put all your money into the share buyback, you increase the share value, and then your share value goes up. And every single year you're doing your buybacks. You do it for 20 years. Of course, you basically give like your shareholders a 200% return over 20 years. That's pretty cool. They're like, yeah, a basic company doing share buybacks, using its free cash to reward its investors. This is what I would say Warren Buffett talks about, right? He's saying that you should invest in companies because they generate cash, they generate values, and they can increase the value of the company and your worth. And typically they can do share buybacks or they can do dividends. There's a reason why companies don't do dividends anymore. They used to really do a lot of dividends, but then dividends were taxed. And when the government started taxing dividends more, share buybacks was because of the capital gains. And in many countries, share buybacks, capital gains are not taxed, especially in safe haven countries, where the wealthy investors store their money or corporations go for tax benefits. The share buyback programs are what they want the CEO that they elect to do, because they don't want dividends because that's less profitable for the company. So that's why you see most companies today, they don't pay dividends. You're like, wait, what? If you look at companies like, I don't know, in the 50s, they all paid dividends. Nobody thought like, well, you need to do share buyback programs because dividends actually are easier to control. But anyways, here we are in our reality today, companies do share buybacks instead of paying dividends, most of them. But what if we are in the same situation, right? We're the same company and we have decreasing interest rates, right? Well, it's actually quite interesting. Let's say I decide to do my share buybacks. I can still do my share buybacks. And if I decide to put all my money into the share buybacks, I can buy more shares. Of course, if I was going to do the same amount of shares, right? The share buyback as in the previous model, that means that I was going to do 8, 7, etc. I could potentially also increase my capital and increase the health of the company against external shock. This is something that, I would say more conservative companies, they will consider doing. Like if you have a decreasing, I would say, decreasing interests, and you want to increase the total value of your company, I would say most non-public, privately owned, smaller companies who have single ownership, they tend to not do share buyback because it doesn't do anything for the company. I mean, you're buying your own shares and you're not publicly traded. What you're going to do is, if you have less debt, you would actually try and increase your capital, your cash, to pay up for the day when you actually need to pay your debt, and do reserves in case of external shocks and to fix broken pipes and so on. This is sort of like for smaller companies, it's great. But for major companies who are publicly traded, actually there is an incentive. It's actually a really bad incentive, is you can do leverage against your earnings. So imagine if you are this small company, right? You're this company, the same company that is doing these share buybacks. You decide that it's not your company. You're the CEO of the company. You might have some stake in the company, but you're elected by shareholders for you to reward them on the open market. And your goal is to increase the share value price. So what could you do? Well, you could use your free cash after you pay down your costs, and you can say, okay, I'm gonna borrow money against the free cash, right? So how much money can I borrow against my free cash? Is every single year I can borrow, like, okay, I can do this, I can borrow like a little bit, and then I would have to pay back every single year. And then you can see that from here I am borrowing against this free cash, this amount, and I've increased my debt by $150. As the interest rate before is going down every single year, I could borrow more, right? So we're in a decreasing interest rate environment with with fixed income, and every single year, instead of like saving up money as a CEO whose objective is to increase the share value for my shareholders so that I get bonuses, is that I use my free cash and I use leverage, and I do share buybacks with leveraged free cash. And you can see that for a long time, as long as the interest rate keeps dropping, right, like in our current environment, I can increase the share price. However, if the interest rates start increasing even by 1%, in this case I'm increasing it by 2%, the interest payment explode. Because for a long time, let's say I don't have to do interest payment, but then I have to do interest payment, and if I only do share buybacks, I never invested in increasing my revenue, the company could be like worth on paper a lot, but actually the earnings are still the same as it was 20 years ago. So it's kind of trash. It's not great. So this is the thing. If you see companies that, this is like a really bad example of a CEO, like, leveraging cash. But the thing is, this is actually still kind of safe because you're not leverage. You can do much worse than this. You can try to leverage. Right now I'm showing you if the CEO was unscrupulous and leveraged on free cash. Your CEO can leverage on earnings, direct earnings. He can leverage on the earnings before interest, taxes, and depreciation of assets. So they can do that, and it allows them to buy much more of their own stocks. But what's worse is they can also issue new shares. This is what happens if they have new rounds of investments by issuing new shares and raising new capital, like we see in many of the many startups, like WeWork. They can make it even worse. They can like really increase it. So in this case, like let's say if a company has fixed income and the interest rate is fixed, and you put a CEO there, either it's a publicly traded or a small company, probably if they can keep their income fixed, they could increase their revenue, their share value, if they only do share buybacks, by 200%. That's good. If the interest rate decreases, and they choose to do share buybacks, they have more cash, they can increase it by a little bit more, not much more, but just a little bit more. It's still nice, it's good, it's a little bit more performing. It's great for the company. But if they're greedy and they decide to expand their share buyback program with debt, they can increase their value of the shares by almost 800%. You're like, what, 800%? Yeah, from $100 to $800. Now I'm gonna show you something else. This is gonna be shocking. What if I decide to leverage my earnings and use borrowed money to pay down my costs, right? And use new investments to continuously increase my capital so that, and use the increase in value of my shares to justify borrowing new money and sell my company as a growth company. This is like a scenario you see in a lot of startups. Like I was saying, you see something like it's very similar to what WeWork did for its shares, is that, they have rounds of investments. Every year they announce new investors are going to give new rounds. The interest rate is relatively low, and if we had kept on seeing lower interest rate, actually WeWork crashed. It's good because of the pandemic, but if there was no pandemic and we decide to lower interest rate and they actually survived and they're still borrowing money against their earnings, and they constantly raise cash, is they could have ballooning debt. That means their debt increases at an exponential factor because their earnings, of course, seems to their earnings, okay, we're going to say like their earnings do increase slightly, like 10% every year, which is pretty good. Actually, it's not WeWork. This would be like, actually, no, this is like WeWork. They expand a lot. They do use some money to increase earnings, but, and they increase it by 10%, which by any measure, if it was like in the first case scenario, by this case scenario, it would be extremely good. But if you're using leverage, debt, new investments, and you combine everything together, right? Even if you're growing your revenue, basically, as long as your debt outpaces your earnings, it's pretty bad. And you can see clearly if you're bleeding cash and you constantly new injection for capital through your, basically this is cash from earnings, you could have a very quickly ballooning debt balance. And the bad thing about this, well, is that, it only takes 1 year to bust your company if the interest rate increases. And you're like, yeah, but no company is like that in the world. And I'm sorry to disagree with you, but there are plenty of companies like this. And I just went on to, I was like, when I was doing this analysis, I was like, it seems like, that companies are, if this is the case, we have low interest rate. Do I see symptoms of companies right now doing a ton of share buybacks? And, and to my surprise, there's actually a website that tracks it, because companies have to announce their share buybacks. But the thing with share buybacks is that it's kind of hard to track how often and how much shares companies bought back in their year-to-year balance sheet. It's not stated. They do have to make one announcement, but unless you decide to track every single announcement through the whole course of its, last 10 years, you will have no idea how much of their shares they're buying back. And you have to, it's almost like forensics work. You have to go through all of the share buybacks for every single individual company and to see if they're actually like funding their buybacks with debt. And then you actually have to go into the company and look at their exact financials, and not just their balance sheet, but their cash flows like month to month, and then match what like money is going where, which is really hard because, they probably have one or two or three major bank accounts, and then all the money that they're borrowing, everything, it just goes in there. Unless you're the CFO, you have no idea where that money is flowing into what part of the company. So it's like, it's, unless you're a CFO or you're the auditor, or you are, even for the auditor, you have to go through every single piece of financial document, every single transaction flow. There's so many, it's like, it's very hard. So anyways, I just go into this company and I'm looking at this and I'm like, oh, this is interesting. Like some of these companies are doing 7% buyback in the middle of a pandemic, 6% of the shares. That's 10%. Like, how the hell are they funding this? What are they funding it with? I was like, did they have extra revenue or something? And so I decided to look a little bit more into their financials, and I look at their share prices. I'm like, okay, they're trying to like increase their share prices because everything's green, So then I decided to look at one company. One of them was MetLife, and I looked at it. I was like, okay, MetLife is this one that's doing 7%. It's one of the more recent ones. They announced on the 11th that they will do 7% of the shares, $3 billion. Let's see, what's the revenue? They have $6 billion operating income. So this is their EBITDA, and this is before interest and taxes. And basically their net income is 5.9 million. You're like, oh, that's a lot. And then I'm like, okay, but they have a total of like 69 billion of revenue. So they actually have close to $60 billion worth of cost. That's a lot of money that comes in and goes out, and they have to pay down a lot of money. They also have a ton of assets, but it means that they all, this is a funny thing. A debt is at the same time an asset and a what they call what is it called? In French, it's called a passive. Anyways, basically, there's this equivalent amount in the other side of their balance sheet, and it doesn't mean that they actually have $7 billion worth of physical assets. But if you look at the company's like long-term debt, this is what I was talking about. They have $740 billion worth of assets, but they also have $706 billion worth of debt. So I'm like, whoa, that's a lot of debt. That's like a really lot of debt. So I'm thinking, okay, well, if their like revenue is $6 billion and they've got $700 billion worth of debt, all it takes is like a 1% increase in the interest rate, the interest rate market to completely bust this company. Like if you increase interest rate by 2%, right? I don't see there how much free cash flow they have. They have 13 billion. They have 1.3 billion dollars worth of $13 billion worth of free cash flow, which means that annual free cash flow, which means that if you increase it by 2%, they go into negative, all right? Because interest rates are something you cannot avoid paying. And if they go even more and they have more unexpected costs and external shocks, they would go, how much do they have reserves? It doesn't say how much reserves they have, but I suspect that they would go bust in like a year or 2 years. That would be that would be pretty bad. That would be like this scenario, which I'm showing you, like the WeWork scenario, where the company is pretty much highly leveraged on debt, and it would take about 1 year for WeWork. Maybe in this, they're better off. They're maybe like in this case, where they have quite a large debt. Basically their revenue is very low relative to their debt, and they would go bust. Actually, it's very similar to this scenario. They would go bust in 3 years, basically. That's if they have a lot of capital. But if they don't, you could see them go bust in 3 years. So if the interest rate rise, for me, this is kind of like, it signals that really the Federal Reserve, if they care about how the stock market is doing, they have zero possibility of increasing interest rates, because all these companies, they're not profitable. They're not the profitable in the traditional sense. They're not like creating enormous amounts of value for the economy. Their returns are anemic, like their earnings are anemic relative to the debt they have, and basically the only reason why they're able to generate such low returns is because they have huge amounts of debt and access to large quantities of debt. And that's not a healthy like company atmosphere. That's really like it's like a sick man on life support. That's what it's like in terms of company health. Any external shock will hurt these companies so badly. It doesn't even have to be a pandemic. It could be like supply shortages, or even in this case, like people not having money to pay their insurances. That could really hurt these companies. And yeah, that's why I personally stay out of the stock market, because I had more of it in an intuitive sense that the debt balloon was too big. But when I look at how fast companies can balloon their debt, like if I just run this case where they're doing 100% of their leverage, they leverage 100% of their earnings, it's pretty shocking. Which because the effect compounds, it compounds into buyback power. And when I look at MetLife, I'm like, yeah, but you have so much debt already, and you're buying back 7% of your shares. The first one that came to my head that I thought about that did this for a long time was Harley Davidson, and their sales have been suffering, so their earnings have not been increasing, but their share price has been going up, and because of the decreasing interest rate environment. And I've worked with quite a lot of companies, and I know that most CEOs, they are rewarded purely based upon share price increase, not based upon earnings increases. They're rewarded based upon share price increases. You saw was like even Elon Musk. Elon Musk has almost direct. He's kind of like a sole owner of Tesla, but he's not. But he's a CEO. But even his earnings, right? He's very much attached to Tesla. I'm just saying but even his pay structure, it's incentivized for him to try and increase the share price as much as possible. But at the same time, he does some stuff that doesn't try to pump the share. I don't think he's ever tried to pump Tesla shares. He's tried everything to actually try to decrease the share price, like stock splits, share sales to raise cash, which is a good sign. Actually, I think that's a healthy sign that he's doing something right. But if you look at some of these other companies, this whole page is filled with companies just abusing what I guess is, because I haven't gone through every single one of them. I went through MetLife, and I was kind of shocked that they had so much debt, and it would only take a 1 to 2% increase in interest rates to actually bust them. And the Federal Reserve said, and the speed that it would take to bust them in 1 year, 2 years was higher interest rates. But the Federal Reserve said that, we're going to increase interest rates after 5 years. So, and the interesting thing was they also said that they would notify people ahead of time that they're going to increase interest rates. So I guess a lot of these companies, they're like, yeah, we know if we increase interest rates immediately and you guys have been doing share buybacks, you'll go bust. So we're going to tell you ahead so you prepare and try not to crash everything. I think they won't prepare. They're going to be greedy. They're going to do it to the edge, and then hope for a lot of them are going to bet for a bailout, that they're too big to fail. And MetLife was one that did fail, too big to fail tests, and they were fined, but they were fined a few $1 million. So that's no punishment. So going back to gold, do I think gold will rise? Well, I think gold will continue to rise because the dollar is tanking. The dollar is basically in the trash basket. That's the thing. The dollar is kind of in the trash basket, and the Federal Reserve said we are going to keep it there for at least 5 or 6 years, and we're going to give money to the government. And we're going to give this money. It's your job to make sure the economy grows. Hopefully the government does do the right thing. At least we're seeing signs of it. They're like, okay, we need to do at least some direct stimulus so people are spending in the market. It's not, helicopter dropping is not a bad thing, especially if done this way. If the Federal Reserve just deposit money in your bank account, they can't recover it. But if they lend to the government and the government gives them debt, they can control monetary. Actually, that's what they want. They don't actually care whether what the government does, but they don't want the money to. They don't want to not have the ability to raise interest rates in the future. But by giving it to the government, they also know that these guys are stacked with lobbies and they're going to try to like spend money wherever in the wrong places. They've been trying to encourage them to fight, like they say, part of their objective is inequality, because they know that, like, you know, if you give money directly to people in a stimulus package, and you give it to the people who need to spend it for their daily livings, they will vote with their dollars. You know, they'll vote on the things they need with dollars. Businesses hate that. Like big businesses, big monopolies, big duopolies hate that, because obviously people won't vote for them because they hate their services. They only had to buy it because they had no choice. If there's a competitor that comes up, I don't know, like if you watch a lot of these analysts are talking about Lemonade and all these other stocks, you know, if you give people money to be able to pay for their own life insurance and you run it like a free market, they're going to vote for maybe Lemonade because maybe they have less, their insurance policies cost less and you get it faster, you know. But if you don't give it, you decide to do trickle down, you give it to all the insurance companies directly, and you're like, okay, then you hand it out to your employees, and your employees are going to go into the market. They're never going to hand it out to the employees. They're going to do share buyback programs. And then they're going to go on the stock market and tell people like, oh, look, we increased our stock price by like 8%. Why would they even give it to other people? If you ever read about Adam Smith, the first part he admits is like, you know, people have greed, but you know, the way we can like sort of use greed for the good for all is to have a free market and have people vote with their dollars. Yeah, if you give the government, if you are a government and you're responsible for like monetary controls and you give money directly to companies, that's not a free market. That's socialism. Anyways, socialism. Yeah, sometimes I think it's funny like how people describe socialism, but that's another story. Anyways, I think gold, I told people, if you look at my few videos, you know, potentially at this point, we're going to see these are good bets. They were good bets to make, that the Federal Reserve was going to raise, do more QE. And gold's, I would say, fair valuation is around $2,000, considering the current environment. I think a lot of times people price it in here. There was a pullback. It's normal to have a pullback after such a vertical raise. You know, they said we were going to do that QE and then it maintained this level. Will it go back? I think if the Federal Reserve decides to do QE and we see more QE over time, we are going to see $2,000 gold. And then potentially if they do it for 3 years, you know, we're going to see from possibly like $3,000 gold at the end of the 3 years, $4,000 gold. Depends on also what happens on the fiscal side. But if we just take it only into consideration the monetary side, the gold price is going to increase. It's just going to go up. There's a really good case for it, you know. So yeah, if you like the video, thanks for watching. Click the like button, click the subscribe button, and just be aware that, you know, this is not financial advice. This is just my opinion and some stuff I'm looking at. And this is what I do for myself. I don't recommend anybody else go out and buy stocks or trade based upon stuff I say. I am not a financial advisor. I'm not an expert at this. I only ran my program based on something I found on the internet about some other guy's algorithm, and I've been tweaking it to get better results. So this is not financial advice. The stuff I'm looking at, it's not necessarily going to work. And don't trade off of it, and use your own judgment to make your decisions. Thank you very much for watching. This was Dave. Dave out.